This is Financially Fit Radio with Cory Sickles from Safe Harbor Wealth Advisors. Retirement isn't just about saving, it's about having a strategy that helps you navigate market ups and downs, combat inflation, and secure the future you deserve. That's why Financially Fit Radio is here to tackle your biggest financial concerns, share actionable strategies, and help you move toward your retirement goals with confidence. And now, here's Financially Fit Radio with Cory Sickles.
Back to Financially Fit Radio. I'm Cory Sickles with Safe Harbor Wealth Advisors. If you'd like anything, if you'd like any information, feel free to give us a call at 614-760-0670, or you can always visit our website at safeharboroh.com. And once you go to our website, feel free to check out our radio page. You can listen to today's show. You can also subscribe to our podcast via Apple Podcast, Google Podcast, or Spotify. Also, feel free to watch today's show on our YouTube channel. Just type in Safe Harbor Wealth Advisors. You can go to our YouTube channel. You can also subscribe and be kept up. Fit shorts out. We're doing about 3 or 4 shorts a week on different types of financial topics, just really out there to be able to educate you. Well, today we're going to talk about it's going to be a market recap of the first quarter here of 2025. We have a special guest, Keith Gangl, who will actually be joining us as well. But before we kind of dive into that, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
I'm great. You know what, Cory? I am so good. If I was any better, my name would be Keith Gangl. Oh, wow. That's how good I'm doing today. I'm
Cory.
I'm great. Well, I'm excited about today's show. We're all in the studio together. It's great to have you guys here in the lovely palatial Lucon Media Studios today.
Awesome.
In beautiful downtown Arden Hills, Minnesota, just north of the Twin Cities. Great to be here. I've had a great week, Cory, just really busy. How about you? You've been doing some traveling. You came up to see us.
Yeah, I have been. It's probably 50 or 60, down in Columbus. Get here, and you guys gave me a nice little snowfall last night.
Yeah, it's in the 20s and snowing. So, yeah, it's about 32 right now. Snow outside, about an inch for you. We got an inch of snow for you.
Yeah, so anyway.
Gone.
Yep, hopefully I'll be able to head back today on, travel on time.
Sure.
But, I was actually up here with some of their advisors learning about, what everyone loves to talk about, and that's life insurance.
Yeah, everyone loves to talk about life insurance. Our listeners are like, wait, you're not talking about life insurance today, are you?
No, we're not doing that.
No, we're not doing that today.
But everybody does need life insurance.
Yes, it's very important. It's just we're not going to bring in Ned Flanders to try to sell you some life insurance today. Don't worry about that. We're going to talk about the craziness that is the marketplace. The economy. So we're going to dig into that. That's why we have an expert with us today. I'm excited because Keith Gangl is the senior portfolio manager for Gradient Investments. This is a fast growing investment firm that's been around a while now, done great. So I'm excited about that. What do you think, Cory? This is a good show, right?
It is a good show. We had Keith on a few weeks ago, got to talk about the lovely tariff.
Oh, that's right.
Everybody's favorite subject matter.
Yeah.
Tariffs.
Tariffs.
I was terrified to talk about those.
You're not the only one.
Yeah.
But obviously I think a lot of people are concerned right now with where the market's going to potentially go. Everyone, this is the time, but this is what I actually say. This is actually where I think I really make our money for our clients, is when we have a down market. We'll talk about some of the things that we do as well, but when we have a down market, this is where I think working with an advisor can really help you, because some people just want to get out of the market, Keith. Mm-hmm. And obviously in the long-term scheme of things, this is just going to be a little roadblock that's really taking place over your overall retirement or portfolio.
For sure. Yeah, no, you do a great job with your clients, allocating, you do the plan up front, stick to your plan, right? Over time, markets generally grind higher. Yep. And you got to remember, so we're talking about kind of the Q1 kind of recap. The S&P 500, the first quarter was down 4%. At one point intra-quarter, we were up about 6%. So then you mentioned we had this correction, right? That means we're 10% off the recent high. I think we're only in correction 1 day so far. So we'll see if we stay in that. We had a little bit of a bounce as well. So again, but you got to put that in perspective. You take a step back. You remember what happened in 23 and 24? Pretty good years in the stock market, right? We were
great years,
25% plus in both those years. So, I mean, if you were just in the stock market, again, most of your clients, you're going to have diversifications for, when you have drawdowns like now, you're not full, feeling that whole thing as well. But for the past 2 years, you'd be up 60% in the stock market. So to have a year to date down 4% off, up 60, not too bad, really. So it's everybody to keep that in perspective.
But I think what you have to remember is they forget that.
Oh, for sure.
Clients forget that.
Yeah.
So, this is why, as we kind of talk about some of the things that might be affecting, the volatility in the market and things like that. But this is why it's so important to make sure what your risk level is.
Yeah.
I mean, it's so important. That's why we have our color of money risk analysis that we do for our clients. We redo it every year. But what you have to be, which you really have to make sure that you understand what risk you have, and then you can afford this because you have a long-term plan on where you want to get to. So it's so important to be able to do that. Obviously, tariffs, inflation's out there. We have some, tax policy. We have a new administration. I mean,
yeah, a lot of stuff
going on right now.
Yeah, there is. Wow. We're recording this on a Wednesday, and is it the 2nd, April 2nd? It's supposed to be Liberation Day. Isn't that what they're calling
that's what
today?
They call it. At least it's self-proclaimed Liberation Day. So we'll see what the impacts are.
If the tariffs are actually enacted today. It'll be interesting to see what the market does, won't it?
Yeah, there's a lot of things going on, and like I said, you do a fantastic job because every client that comes into your office, everybody's different, right? Unique. So you built a plan for them. You can't just say, okay, you're going to be all in the stock market, right? You have clients that maybe they need some income, maybe they want growth, maybe their risk scores 55, 60, maybe the next person's 75. So you build a plan working with us that you actually have a plan that you can stand this volatility, right? You use a lot of these buffer products, and I know that that's a big use for you because they protect from the downside. So some of this volatility that we've seen where the markets are off 10%, those buffered portfolios aren't off 10%.
That's correct. That's exactly right. We do a lot, we do a lot of buffered products for our clients. And just as a reminder for that, like right now we have one that we have 100% buffer. You keep your money in there for 18 months. It's based off of the S&P and the Dow Jones.
Yep.
But what you need to realize is as long as you keep that money in there for that 18-month period, the worst you'll ever do is make zero.
Yeah.
Get your money lose back. Zero, right? But you do have a cap of around 13%, which means you could make up to 13%. So it's a great way to be able to be in the market, but not be in the market.
Right.
So, and obviously we have some different types of buffers, depending on if you want to be a little bit more aggressive and things like that. But what I always tell clients is this is a great way to be in the market with protection.
Yeah.
And during this time frame right now, this is why you really want to be in a buffered type of product.
Yeah, the last 2 years, the market's kind of over. Typical client that we see, and I'm sure you see as well, they're looking for that 5 to 6, maybe 7% return to kind of satisfy their needs. In the last 2 years, we talked about the stock market being up 25% plus. And if you own some of these buffers, maybe you were only up 18, but you were still outperforming your overall plan. And so now with these buffers, when the market's pulling back here, they're protecting you from this downside. Just like you said, if you're in that 100% buffer, 18 months later, worst case, the market stays down.
Correct.
You're getting your money back. And then if you have, some more aggressive ones that are maybe have there's some ones that we have are 20% caps. We have ones that are uncapped as well. So there's different ways of playing it.
That's exactly right. And again, it all depends on what kind of risk level you have. 100% buffer is a great way if you have money just sitting in the bank.
Yeah.
Obviously with, at some point in time, we're going to see interest rates drop. Maybe we're expecting maybe twice this year, but that's going to have a big impact on what you're actually making at the bank.
Yeah. Yeah. Right now, speaking of where expectations are for interest rates this year, right now, the 10-year yields kind of pulled back here. Expectations for the Fed to cut 2 times this year, another 50 basis points. So if you have money in CDs, your bank rate as the Fed cuts, generally speaking, your short-term money, you're going to earn less on it. So that you have some opportunity, like you said, with some of these other portfolios that you're using as well to make better.
Yeah. This is one thing I think that I'm just looking on our notes here that I get a lot of questions on, and that is, should I be in gold?
Yeah. Well, that's a great question. I mean, now, so if we look, we mentioned the stock market's down about 4% year to date after those 2 big years. The one standout with all this volatility, all these kind of concerns that we just mentioned, that laundry list, is people are actually flocking to gold last year and this year. So, I mean, gold's actually up. Stock market's down 4%. Gold's setting all-time highs, and we're at over $3,100 per ounce, which gold prices this year up 19%. Think about that. That's a big number. And the reason people are going to gold is it's an inflation hedge, which, inflation's kind of sticky around 3%. Yeah. And the other thing is when people are fearful, the two things that they typically buy are buying bonds for safety, right? So when bond prices are going up, yields are going down. That's what we're seeing partially. But also then they're going into gold, which gold, I mean, again, up 19%. I think last year was up 20%, some back-to-back years, which we got to be careful, to just the fact that it's kind of a little bit of a fear gauge as well, right? So the fear is kind of with all those concerns out there. That's why gold is doing so well. So now, would you want to be putting new money in it? I'm not so sure. I think it's for a small part of your allocation, right? For diversification. Sure. I'm more in the Warren Buffett camp of, gold over long periods of time. I'd rather invest in companies, but I certainly see a reason to own a piece of it in your overall allocation just for that safety level
within a portfolio, within the market. Yep. And investment portfolios. We're not talking about physical bars in our closets.
Exactly right.
Yeah, because if something happens, you can't go down and buy a tank of gas and shave off a piece of gold to pay for it.
Yeah, right? No, it's difficult, but it's certainly, I mean, people are buying it, and you see. The funny thing is, you see even at one of my favorite stores I talk about is Costco. You see Costco even selling gold, right? So the coins,
yes.
So it's amazing that, how popular that's become. So
there's enough TV and radio ads on that stuff right now.
Yeah, part of it's a little bit like the fear mongering, right? And that's an easy one, right? They're trying to drive traffic to their website or whatever they're selling, right? Things like that. Yeah. So that's why you always got to be careful, and that's why we like to set both sides of the facts out there so people can decide for themselves. But gold, again, it's doing well, but usually after something's done that well back-to-back year, just like the S&P back-to-back years, we're saying expect more of a normalized year this year. Now, gold's had 2 fantastic years, so just be careful.
Yeah.
I mean, which is I think why you manage a precious metal portfolio for our clients too, and you have the nice part about that is you have more than just gold in there.
Yeah. We have silver, palladium, we get other industrial things like I said, gold is more of a store of value, so that's going to supply demand on the actual gold. Whereas some of these other materials that whether it's silver or platinum or palladium, that it's driven by, if we think in the industry is doing well, like in Cadillac converters and cars, that's something like that could do very well. So
So are the price of eggs going to go down?
Yeah, price of eggs are going down. I mean, what do we hit, like $6-7 a dozen? I think they're down a couple bucks. So inflation in general. So that's kind of, I think, what you're.
Yeah, I was good. That's my lead into inflation.
Yeah, that's kind of if you got
eggs. When we say eggs now, that's our alternate word for inflation.
That used to be toilet paper. Remember that?
Yeah. For a good year and a half, it was toilet paper.
And so eggs too, right? So that, I think the egg situation with chicks and hatching the actual eggs is actually, it takes a while to play out, but now the prices are actually coming down. But inflation, to your question, kind of front running on that, is inflation right now is around 3%. The Fed wants to get it down to 2%. If you remember back in when we had that inflation spike, was at 9.1. So we've gone from 9.1 down to about 2.5. Now we're bouncing between 2.5 and 3. I think it's going to take another year plus to get to that ultimate goal of 2% by the Fed.
Sure.
But I do think directionally we're in the right spot. It's going to be sticky. It's that, that easy come down from 9 to 3.
Yeah. I think tariffs in the market have actually played a part in inflation and the economy. And once that settles, like you said, a year, maybe everything will settle out and we'll be done with the not sure what's going to happen. We'll settle into some set tariffs and then things can start to get back on track for the Fed's plan, right?
Yeah.
A couple more interest rate decreases maybe.
And one of the other big things that contributes to inflation is price of oil, right?
So,
So that's, here in Minnesota and Ohio is price is generally around $3 a gallon. I'm not sure where it is in.
It's a little higher than that.
A little higher. So, but I mean, generally speaking, that's certainly better than 5 where we saw during an inflation spike. But ideally, we'd probably like to see it at 2, because that oil prices go into everything. Everything you buy, whether you're buying, like Tony likes to shop at Amazon, everything's getting delivered, right? It's There's a lot of costs no matter what you're buying. Fuel costs, even if you're not driving to work, you're probably having something delivered or things like that, or resins and materials you're buying, right? So
and oil inside of products. I mean, people don't realize that plastic is an oil-based product. So
if you get oil prices to come down, that could maybe help offset some of this other inflation that tariffs are actually, kind of keeping up. So,
so just where did you think the S&P 500 was going to be in January of this year? Where did you think it was going to be come into the year?
Yeah, that's a great question.
Now, then take that and just say where do you think it's going to end up?
How did you do? How did your estimates do?
I think we're on track. I mean, before year end, our kind of forecast for this year was a normalized year. Expectations should be dialed back after 25% plus last 2 years. So normalized years, think of 8 to 10%. I'm still sticking to that target. But our theme coming this year was bring an umbrella. And what we meant by that is, again, if you were in the stock market the last 2 years, just the stock market, 25%, you were actually up 60% in 2 years. We said, and if you were a COMRA, your client was a 60-40 client, which means 60% stocks, 40% bonds or safety, that now look like 70-30. We wanted you to rebalance, and that's exactly what you've done with your clients. That, or you introduce, if you haven't used buffered, introduce buffers. Again, you were using that already. So you've already, that playbook's already been in place for you. But that's what we're telling all of our clients and advisors to make sure, bring an umbrella, which means we don't know if it's necessarily going to rain or pour, but if you have an umbrella with, and you get this little rain, kind of what we're seeing, or if you're in Minnesota now, we're getting a little bit of snow, right? Maybe you whip out your umbrella to help you protect on that downside so you won't get wet. So that's kind of where our theme is, but doesn't mean sun's not going to come out. I think we get through this choppiness in this next quarter or so. And I think, my crystal ball, our forecast for year end is I still very comfortable with that normalized return of 8 to 10%. We're down 4 now. Markets can change in a heartbeat here. And I think generally speaking, there's a lot of things that are in place fundamentally that reason I'm positive, right? Unemployment at 4.1%. Tony, when people are working, you think they like to spend money? Yeah. U.S. consumers, they have no problem spending money. So unemployment at 4.1, that's still, historical lows at 3.4, not too far off that. Average is about 5.5 for the last 50 years. So we're at 4.1. People are working. They have money in their pockets. They will spend. I think they're getting a little more selective lately. You're starting to see that, right? You can kind of, company commentary. We just got done with earnings season. People are, whether it's tariffs, you got Target saying, people are spending, but they're maybe thinking about slowing down because they're not sure where prices are going.
Saw an article on that. People are actually buying less in groceries, spending less at grocery stores and Targets and Walmart.
It's your discretionary items.
A little bit. And that's went down a little bit, but overall spending is we're still consumer driven, and
which makes up 70% of our GDP. The other factor I look at to help support the thesis that the market could still be up is earnings growth. Earnings growth for the S&P 500 coming this year was forecast consensus was 15%. We said that was way too high. Again, so now estimates have come down to about 11%. And if we were doing 6 to 8, I think that's a good backdrop for that normalized market return. So I still think 11 is probably still a little too high. I think that comes down. But if we're going to do 6 to 8, we got the main drivers in place. We got earnings growth rate of high single digits. You got unemployment. GDP is hanging around 2%. Now, GDP, a lot of Wall Street forecasts are coming down the last 2 weeks. They're starting to change their tune on how much tariffs could impact them. That over 2% GDP is now starting to go down towards 1.5%, right? That's kind of getting on the lower end of the range we'd like to see. So again, we'll have to wait and see what exactly comes out of that.
And, obviously, I think at some point in time this year, we're going to see some tax legislation take place and hopefully make, the tax rates obviously permanent compared to they're supposed to end by the end of this calendar year.
Yeah, that was the biggest thing that I thought was a risk, going pre-election, was the fact that when Trump won, that should keep these tax, cuts that in place that we're going to sunset into 2025. Now, personally, if I was helping with the administration with their policy, that would have been my number one thing. Let's get this locked down and saying everybody likes,
because everybody's going to feel good then. And you Yeah, that probably would have been a good idea to launch your
lead
new
with the
term.
tax.
Yeah, lead with making that permanent.
Obviously, people like
rates.
less taxes, but even at these levels, I think most people are comfortable or used to them. So I think if they can lock it in to make them permanent, like you said, and not having to sunset in another few years, that would make investors feel comfortable. Companies can plan accordingly. Now, as we go throughout this year, if nothing happens on that, that could be a headwind. So now, we'll have to see what, the tariffs seem like that's agenda number one. Now, number two certainly needs to be this tax, cut or remain the same. It's not even a cut right from these levels. It's just, we don't want them to go back up. If they go back
we're
up,
at historic lows right now. So if they make that permanent, the Tax Cuts and Jobs Act and everything it entailed, the standard deduction helped a lot of people. So I think that's great. I hope that they do implement that. And I'm shocked, like you, that they didn't just right off the bat, let's make these permanent.
Yeah, and they're definitely now they're getting back. There's a lot more talk on what they're going to be. Again, it's early in the process, right? Sure. They always give you some give and take because obviously the Republicans control the House, the Senate, and the presidency. But that being said, they're very slim margins. So there's always some defects along the way. So they better make sure they get this all in place before year end. Otherwise, taxes are going up. Then we start looking at another election. It's just,
the midterm.
It's crazy, how that goes.
Yeah,
so that's why that's why it needs to be front and center. I think sooner rather than later.
Yeah. So for our listeners out there, I think one of the things that obviously we talked about the market, but just kind of a recap of really what you should do, from this point forward. I think it's always a good opportunity. You can always give us a call at 614-760-0670. Or you can visit our website at safeharboroh.com. Schedule a complimentary, no obligation meeting with us. We can kind of, one thing I truly believe in is education. We can really educate you on how the buffered products work. This is a great time. If you haven't done it, you really need to rebalance your portfolio. We try to do that at least every beginning of every year, just like you said. Even if you were 60-40 within the last couple of years, with the growth in the stocks, you're no longer 60-40.
Yeah, 70-30.
You're probably more like 70 or even 75-25. So it's always good to be able to rebalance that as well. And here's the one thing. Corrections happen, right? And this is where I think it really pays to work with an advisor because we're going to stick to the plan. We take the emotion out of it. And I think that's so important to be able to have you guys, have the client just focus on living. And if you're working with an advisor, we're going to we're going to do always what's best for you.
Yeah. You take that off their shoulders, right? And you handle it. And you're professional. You're working with us. I mean, the one stat that I always throw out there is long-term average of the S&P 500 depends on you looking the last couple of decades or whatever, or longer. It's anywhere between 8 and 10%. Last couple of decades has been closer to 10. You look at the actual average return for individual investors that are doing it on their own without an advisor, it's more like 3 to 5. And the reason for that is because they chase performance. Like last 2 years have been super bullish in the market. What do you think they're doing if they're on the sidelines? They're buying it in, and then they buy high, and all of a sudden the market sells off 10%. What do you think they're going to do?
They're going to panic.
They're going to panic. Exactly what you tell your clients not to do. If you have a plan up front, you don't do that. It's like you have that plan, stick to it. Over time, we're going to achieve all your objectives. Are you meeting your income needs? Yes. Are you meeting your long-term growth needs? Yes. We don't need to be chasing performance. That's the worst case. I've been doing this for 30 years. When people chase performance, like when markets are really good or a subsector of the market's really good, that's generally the time you should be selling or trimming that and moving to something that's not worked as well, kind of that mean reversion type of thing. Now, without an advisor, it's emotional, right? Because it's your money. You saved hard. You worked all your life. You want that. And if you're in retirement, you're probably not getting that income stream that you had before. So you're depending on your investments. And that's why it's very emotional. It's like you need someone there as an expert like yourself to say, this is what we're doing. Stick to the plan. The markets do have corrections. That's normal. We don't like them. I've been doing it for 30 years. I don't like a correction. I'd like to see the market go up 1% every month, 12%, call it a day. Make things a lot easier, wouldn't it?
It would.
It would.
Get rid of that volatility. But that's built in. But even, over the last 100 years, the market's gone up. There have been dips, of course, and volatility, like we're seeing some volatility this year. But I think this has been a great discussion. It's great to have Keith, Senior Portfolio Manager over there at Gradient Investments. I love it. Cory, great show today, right?
Yeah, it was a great show. For our listeners out there, feel free to give us a call at 614-760-0670. Or again, you can always visit our website at safeharboroh.com. And again, I just want everyone to remember, you can give us a call, visit our website, schedule a complimentary, no obligation meeting with us. We're here to help and guide you. And I would like to thank Keith for joining us today. We'll have him on sometime later this year.
All right. Sounds good. Thank you, Keith. Thank you, Cory. And listeners, that does it for today's episode of Financially Fit Radio.
Thank you for joining us for Financially Fit Radio. Don't head into retirement without a strategy that addresses both income and taxes. For more information, please contact Cory Sickles at Safe Harbor Wealth Advisors at 614-760-0670 or visit safeharboroh.com now. Join us again soon for another episode of Financially Fit Radio.
Investment advisory services are offered by Safe Harbor Wealth Advisors, LLC, and SEC Investment Advisor. Insurance products and services are offered through Safe Harbor Retirement Group, LLC, an affiliated company. Safe Harbor Wealth Advisors, LLC, and Safe Harbor Retirement Group, LLC, are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any government agency. All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Calling this number will direct you to a licensed sales agent.